Welcome to the 2024 Economic Preparation and Depression Channel. I'm your host, Tony. Thank you for joining me on this brief Saturday evening edition. Preach to Me channel. Please be sure to subscribe. Thank you for the likes and comments. I appreciate all of your support here on this channel. We're just going to be talking about the Fed rate cut, as well as the optimistic hope is that, we're still adding jobs in August. We still added over 142,000 jobs. Will that continue into September and October and November, the critical months for this going into the last fourth quarter of this economy? So the bets are big, according to MarketWatch.com, for a big rate cut. The recession-wary investors are debating whether a 50 basis point rate cut will reassure or unsettle the markets. So right now, Fed Chair Jerome Powell is thinking about doing 2 to 3 25-point basis rate cuts to kind of ease us into rate cutting, this quantitative easing. But now they're saying that, if they do a 50 basis point rate cut, is it going to be enough to stop this, slide? Because people are going to think now, they're going to be panicking. Is panic entering the markets? And if they do come out and decide to do a 50 basis point rate cut, then that means that things are not as rosy as everybody has been painting it on the media and on the financial channels. So that is the concern. What do you think? I think that possibly they will go 50 basis point, but I don't think initially. They're probably going to do a 25 basis point rate cut. And according to the CME FedWatch tool, they say they saw a 53% probability of a 25 basis point rate cut. And so that's what we're going to be seeing here with this jumbo cuts right here. So they don't do a jumbo cut, they're going to do a 25 basis point rate cut. Now, so the world braces for Fed easing amid 36-hour rate roller coaster. And so now everybody's bracing now next week when the quantitative easing begins, how much helicopter money, how much interest rate cuts are going to help this economy right now to go on. And so this is the decision that's going to take center stage, because remember, European Central Bank, they're cutting rates as well. Not only that, we have economies that are slowing down worldwide. And so, but the U.S. will be the first. U.S. and the U.K. and Europe markets will be the first to feel the effects of the slowdown, and they will be feeling it more brutal, as we don't have as you know, our manufacturing has gone down to zero, and so we're going to be the first to feel it going into next year. And that's why many people believe that next year is going to be a slowdown type of year, at least all the way through June 2025, once we get past all of this election stuff that's going on now. So the sky is not falling. According to CNN Business, the U.S. economy added 142,000 jobs in August. That's true. That is absolute delight that we're still adding jobs. We're still on the positive side. But at the same time, ladies and gentlemen, we're losing jobs. And many of you know that in many of these states that we're losing jobs, not just part-time jobs, we're losing jobs in the white-collar sector. A lot of other jobs in the tech sector are starting to lose jobs. So yes, we're still adding jobs. That's great news. But the question is, what type of jobs are we adding? And most of those jobs are part-time gig economy jobs, some full-time jobs, but they're not in areas that are in desirable geographical areas for families to thrive in. And they're not in areas where things are going to make up the numbers here. So economists were expecting a net gain of 160,000 jobs, but they only got 142,000. And then the unemployment rate, they claim, fell to 4.2%, but we know that the real unemployment rate is around 10 to 12% right now, because a lot of people are underemployed, and that counts because, you got a lot of families that are living together, multi-generational families that are living together. A lot of retirees are downsizing, selling their big houses and living in luxury apartments now, not to mitigate costs, but just to kind of downsize, because they know that what's coming, if you're on a fixed income or not, they know that a slowdown is coming, because we've been up for the last, 14 years. We've been up. The markets have been up. Everything has been rosy. So what goes up must come down. It's part of the natural business cycle, ladies and gentlemen, that we know of, that happens anyway. So that's what's going to be coming. So a weak job market, and all of this is going to lead to quantitative easing here, as you can see. But the quantitative easing that's going to be here is going to be a steady process, and that's going to last through next year. It's not going to help. The medicine is going to be wearing off, because what's going to happen is that the unemployment rate is going to accelerate next year so fast that rate cuts are not going to be making a difference for this economy whatsoever. And people are going to be frustrated because they're going to be just treading water instead of gaining more things with this economy. So that's what's going on, ladies and gentlemen. Thank you for listening. I'll be back with more information coming up Monday, Tuesday, when we get into the heart of these rate cuts and what they mean for sectors such as that have been growing, such as the healthcare, government, IT, technology, and the transportation sector. How will they be affected by the rate cuts that could be coming possibly by Tuesday or Wednesday next week, when the Federal Reserve Open Market Committee meets? That's what's going on. But enjoy the rest of your weekend. Go out, get the sunshine wherever you're at. Exercise, get fresh air, pray. Continue to prepare, because we're still in a marathon, and this is a marathon, not a sprint. Thank you for listening, and I'll talk to you very soon on the next episode. God bless.